So now that I've been making YouTube videos for quite some time now, and I've answered a lot of questions and comments, and I've even scrolled through Wall Street Bets many times just to see what people are doing in there, etc. But point being is now at this point, I've seen a lot of common mistakes that a lot of new options traders are making. And so for this video here, I'll be addressing the top 3 biggest mistakes that I've seen new traders make. And believe me, I made some of these exact same mistakes myself when I first started a long time ago. So hopefully by watching this video, you may realize if you're making these same mistakes yourself. And then of course, going forward, you can stop making them and do a lot better with your trading in the future. Now, as always though, before we dive in here, make sure you guys watch until the end of the video because at that point, I've got a very cool limited time opportunity for you all where you can receive up to 10 free stocks and each stock could be worth up to $2,500. And also, if any of you would like to join a very exclusive online community where you guys can really learn how to successfully trade options, then you can now join my options trading Discord. So make sure you guys check out the description of this video below because I do have a link to a separate video that will tell you guys all about that Discord and discuss the main features and benefits, and also a link to my sign up page where you can join and begin your 7-day free trial. And lastly here, for anybody who is brand new to the channel, my name is Scott, and you can also find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And you will also find some links to a few of my introductory courses in the description of this video as well. So be sure to check them out. And when you sign up for Skillshare using any of those links, you'll get a full 1-month free trial. Alright guys, so now diving in here with mistake number 1, and this one's probably the most obvious, and that is if you're trading way too big, or basically allocating too much risk for each trade that you're making. Right, so trading in general is really a game of chance, or it's a game of probability. And a lot of people like to compare trading with going to a casino, for example, and playing a game of blackjack or roulette, for example. So essentially, every trade that you make or every spin of a roulette wheel has a statistical probability of paying off or not paying off. Now, of course, the main difference between trading and gambling at a casino is, of course, that casino games are constructed specifically to tilt the odds in favor of the casino. So of course, that's why the house or the casino always wins in the end. So even though you might get lucky with a few spins and make some money, but if you play that game long enough over many occurrences, you will on average steadily lose your money. But that right there is the main point I'm getting at. Over many occurrences and on average, you will lose money playing casino games. Whereas with trading, not only is it possible to actually construct a trading strategy that puts the odds in your favor, but still the same kind of concept applies. You still need many occurrences, many trades basically, to actually see the chances or the probabilities play out accurately. And so ultimately, that's why, tying back to my point here, if you trade way too big, then you will not be able to withstand the occasional bad losing streak. Right? Because with a small number of occurrences, let's say you make only 5 or 6 trades, then even if those trades each have a statistical 80% chance of paying off, doesn't matter. That's still too few trades, and therefore you could still lose on every single one of them. Right? Same thing also with flipping a coin. Even though the chance of heads or tails is supposed to be 50-50, but you could flip that coin 10 times, and actually it's possible to get 10 heads in a row. So again, if you allocate way too much capital for each trade that you're making, then if you're unlucky enough to run into a bad losing streak, then you have a very high chance of blowing up your entire account. And I've seen that many times, especially in Wall Street Bets. So bottom line here, my general rule of thumb is not to allocate more than 5% of my total account value for any one trade that I make. So for example, if you have $10,000 of capital, 5% of that is $500. So therefore, you should not allocate more than $500 for one trade. And even doing just that, right, by keeping your risk very small per trade, I can pretty much guarantee you that at minimum, you'll be able to at least survive some of the worst market events and some of the worst losing streaks. And so that's big mistake number 1. Now, big mistake number 2 is overtrading, or basically forcing trades for the sake of simply making trades. So especially for beginner traders, and I can definitely speak from experience on this one here, when you first get started, right, it's a very exciting experience. And so of course, you naturally want to make as many possible trades as you can. And of course, also, this ties back into my first point, right, where I describe trading as a game of chance that requires many trading occurrences over a long period of time. So, of course, it might be intuitive or sound intuitive that you should make lots and lots of trades. Now, the issue here is that there is a fine line between making lots and lots of trades for the sake of simply making trades and having occurrences, and also making many trades, but having them only be high quality trades, right? So for example, as an option seller, that's pretty much what I do as my strategy. There are possible new trades I could make every single day in the market, right? Basically, there are always at least a small handful of stocks on any given day that have high implied volatility, that also have reasonably liquid option markets, and could be worth a possible new trade. And to be honest, this mistake right here is something I struggle with the most, because a lot of the times I would actually go ahead and make those trades because, like I said, they seemed good enough, and also I wanted to have lots and lots of occurrences. But unfortunately, what I did not realize is that by forcing so many trades, oftentimes I had way too much risk on simultaneously, and or my portfolio was not well balanced and diversified. And so ultimately, whenever a major market event finally rolled around, most of the time I got smacked pretty darn good. Right? So for example, consider a bullish trade, let's say on AMD. Maybe I sold the put option on that stock. I'm bullish for whatever reason. But then also tomorrow comes around and I also want to sell a put option or get bullish on NVIDIA. But the issue with doing that, right, is because AMD and NVIDIA are both tech stocks. They're both chip manufacturers, basically, right? And because I want to get bullish on both of them, this ultimately means these are not going to be two different positions. They're actually going to be one larger position. So again, it was mostly in cases like this where I simply had too many trades on, especially trades that were too similar to each other. Because again, I simply wanted to make trades for the sake of making trades and not care so much about the broader diversification or balance of my portfolio. So ultimately, if I did want to have both an NVIDIA and AMD trade on simultaneously, then at minimum, these trades would have to directionally oppose each other, meaning one trade must be bullish and one trade must be bearish. So therefore, if something happens to the tech sector, for example, if things just skyrocket or they totally crash, then I know I'll make money on one trade at least, and I'll have to defend the other trade. So bottom line here is always keep the broader balance and risk allocation in mind for your entire portfolio, and only make the absolute best trades that you can find. So if sometimes you go many days or a week or more without making a new trade, that's totally fine. You don't have to make a new trade every single day. And then lastly here with big mistake number 3, and that is not being consistent. And so what I mean by this is, for example, you can't just make a handful of trades using some kind of strategy and then switch to something else if those trades didn't work out, right? So again, tying back to my first point about trading being a game of chance, I'll say it again, in the world of randomness, you do need lots of occurrences to ultimately see if something's actually going to work or not. So for example, if you're just beginning to try out the credit spread strategy, then make a few dozen trades at least, and then decide if that's a strategy you want to continue pursuing, right? So you can't just quit or switch to something else after only a few bad trades or after a few bad weeks. You may simply have run into a bad losing streak where you flipped that coin 10 times in a row, and unfortunately, all 10 flips were heads or all losing trades. But again, if you just keep making those exact same kinds of trades over and over again, then eventually you will see those probabilities play out the way they should. So even though you may unfortunately lose 10 trades in a row at the start, you may win the next 10 trades after that. So you just have to keep going. So bottom line here is pick a strategy or pick an overall approach to options trading. Of course, I recommend options selling strategies. So that would be things like credit spreads, iron condors, covered calls, strangles, things like that. And stick with them for a time. Make a few dozen trades at least. And then after that point, then you can actually assess the outcome of those trades. And of course, a very easy way to do this as a beginner and not yet risk your real money is to simply paper trade or trade with fake money in the meantime. And platforms like thinkorswim back here have great paper trading features where you can test and experiment all you want. And of course, like I said, not risk your real money. And so there you have it. Those are the top 3 biggest mistakes I've seen new traders make. So again, if you are also making these mistakes yourself, stop doing them and you're pretty much guaranteed to do better. And then lastly in this video, as I mentioned, I've got a very cool limited time opportunity for you all where you can receive up to 10 free stocks. So basically there's a newer brokerage company out there called Moomoo, which is based in Palo Alto, California. And again, for a limited time, they're offering you the opportunity to receive up to 10 free stocks when you open a brokerage account with them using my link in the description of this video. And so the Moomoo trading platform is highly competitive with other comparable platforms like Webull and Robinhood. There are absolutely no trading fees on stock or option trades. You also get direct trading access to US, Hong Kong, and Chinese markets, which is something I have not seen being offered by competing platforms. Moomoo also comes with a free, very advanced, yet totally user-friendly trading platform that you can install on your computer or your smartphone. And of course, everything is regulated by the SEC and FINRA, so your trades and your investments are properly insured. And so if that sounds good to you, then again, use my link in the description of this video to sign up and get your free stocks. And also don't forget to check out and sign up for my options trading Discord, as well as my Skillshare courses. Links also in the description of this video. And finally here, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week and you don't want to miss out. So thanks again for watching, and I'll see you next time.